The hidden truth about your bank deposits, what you need to know. Hey everyone, welcome back to Island Report. Today, we're uncovering the reality behind what happens to your money when you deposit it in the bank. Many of us believe our money is safely stored and fully protected, but there are details that banks don't often share with their customers. Is your deposit under $250,000 really guaranteed? And what does the process look like if a bank fails? Stick around as we break down the dark secrets that banks don't advertise. 1. The Surface Protection, FDIC insurance. Let's start with what most of us know. The Federal Deposit Insurance Corporation, or FDIC, promises to protect deposits up to $250,000 per depositor, per insured bank, for each account ownership category. This insurance gives customers a sense of security, knowing that even if their bank collapses, their funds should be safe, at least in theory. But what does this safety net really mean, and what are the limitations? 2. The fine print, what banks don't tell you. While it's true that deposits under $250,000 are covered by the FDIC, banks don't always emphasize what happens in the event of a failure. If a bank goes under, the FDIC typically steps in to ensure depositors are reimbursed. However, the process isn't always immediate. Depending on the scale of the collapse, it can take days, weeks, or even longer for depositors to regain access to their funds. And during this time, your money isn't earning interest, nor is it accessible for emergencies. Beyond the timing issue, banks use deposits to invest and lend out money. This practice, known as fractional reserve banking, means your deposits are not sitting untouched in a vault but are part of the broader financial system. The bank's liquidity, or its ability to pay back depositors at any moment, can be impacted by economic stress. Widely believed rumors hold that FDIC insurance actually covers just a small fraction of the original deposit amount, for example, 1.5%, or that the FDIC only reimburses depositors in full over a very long period of time, for example, 99 years, the net result being the mistaken belief that FDIC insurance isn't really much of a guarantee at all. In fact, these rumors are so prevalent that they were both included, as numbers number 3 and number 4, in a list of the top 10 misconceptions about the FDIC published in the spring 2006 edition of the FDIC Consumer News newsletter, where they were addressed thusly: if a bank fails, the FDIC could take up to 99 years to pay depositors for their insured accounts. This is a completely false notion that many bank customers have told us they heard from someone on the internet. The truth is that federal law requires the FDIC to pay the insured deposits as soon as possible after an insured bank fails. Historically, the FDIC pays insured deposits within a few days after a bank closes, usually the next business day. In most cases, the FDIC will provide each depositor with a new account at another insured bank. Or, if arrangements cannot be made with another institution, the FDIC will issue a check to each depositor. The FDIC only pays failed bank depositors a percentage of their insured funds. All too often we receive questions similar to this one: is it true that if my FDIC-insured bank fails, I would only get $1.31 for every $100 in my checking account? As with misconception number 3, this misinformation appears to be spread by some financial advisors and salespeople. Federal law requires the FDIC to pay 100% of the insured deposits up to the federal limit, including principal and interest. If your bank fails and you have deposits over the limit, you may be able to recover some or, in rare cases, all of your uninsured funds. However, the overwhelming majority of depositors at failed institutions are within the insurance limit, and insured funds are always paid in full. 3. When things go wrong, the return. So, what happens when a bank fails? In most cases, the FDIC aims to return insured deposits as soon as possible, typically within a few business days. For example, if a bank fails on a Friday, the FDIC may reopen it under a new name or bank by Monday. But for more complex closures, especially during major economic downturns or when several banks face financial distress at once, this process can stretch out. For depositors with amounts over $250,000, the situation becomes even more complicated as only the insured portion is guaranteed. It's essential to understand that the FDIC's goal is to minimize disruption, but it doesn't mean every depositor gets their money back instantly. In some scenarios, depositors might receive a percentage of their balance while the FDIC liquidates the bank's assets to cover claims. 4. Protecting yourself and your money. So, what can you do to safeguard your funds? One strategy is to spread deposits across multiple banks or account ownership categories to maximize FDIC coverage. Keeping an eye on your bank's financial health and opting for accounts in stable institutions is another key precaution. Remember, while the system is built to protect you, knowing these nuances can help you prepare for the unexpected and make informed decisions about where to place your hard-earned money. Thanks for watching. If you found this information helpful or eye-opening, don't forget to hit that like button and subscribe for more insights into the financial world. Let me know in the comments if you have any questions or personal experiences with bank failures.